I remember the first stock that I ever bought back when I was first getting into investing. It was a company called Aqua America, and it was a American water utility company, which has since been renamed to Essential Utilities. Now, me being from Canada, I remember I had to open a US trading account in order to do this, and I remember I wanted to open a US trading account so that I could invest in US stocks because the US market was just simply the better one to be invested in. This was the type of thinking that existed back then, and fast forward to today. Many people still believe it to be true. Many investors around the world want access to the US market because of its strong historical record, its liquidity, and its resilience through many boom and bust cycles. In fact, capital flows into the US from foreign investors have exploded in recent decades, going from less than 100 billion per year in the 1990s to now over 300 billion in some years. Foreign holdings of US stocks specifically have grown a lot, going from 5 trillion in total value just 20 years ago to over $25 trillion today. And a big part of this has to do with chasing performance. In 2007, Vanguard created the VEU ETF, which is a total world stock market index fund that specifically excludes US stocks. And since inception in 2007, this ETF has returned 95% in total, while over that same time period, VTI, which is an ETF that tracks all US stocks, has returned 366%. And US equities now make up 62% of the global stock market value, while US GDP only makes up about a quarter of global GDP. It's this phenomenon we call American exceptionalism, the belief that the United States as a country stands above all other countries. And it's pretty undeniable that, at least in financial markets, this has been true. After the most recent US election took place, there was an even further boost in the US market, which pushed its annual return in 2024 to 25%. So now many investors are starting to get worried if this is too strong, and this performance has started to reach its limits. So, with the new year starting now, I think now is a good time to give some perspective and talk about what has been causing this so called mother of all bubbles and see if what's been happening is actually sustainable. So, generally speaking, stock market returns can come from three different sources: dividends, growth in inflation adjusted earnings, and valuation multiple expansion. Earnings growth is the more obvious one. US companies today are just simply more productive and make more money on an inflation adjusted basis today than they ever have. Back 30 years ago, S&P 500 companies made about $50 in earnings per share, whereas today, adjusted for inflation, it's over $200 per share. And valuation multiples have expanded as well. The Shiller PE ratio is now at a level not seen since 2021 when interest rates were zero, and before that in the dot-com crash of 2000. So companies today are now more profitable than ever and valued pretty highly relative to historical averages. A recent report from Morningstar compared valuation metrics of US equities to equities from other developed nations and very clearly showed that US stocks have higher multiples, not just in earnings, but also in book value and free cash flow. So around the world, investors just have more confidence in US stocks than any other country. The US market today is dominated by big tech, companies that all brought their own unique innovation to disrupt their respective markets and now have very strong earnings power because of that. But this isn't the only trend that has been happening. The increased usage of automation in manufacturing and logistics has reduced labor costs for companies, which has added to their profitability. The cloud computing industry has grown massively, which has allowed businesses to scale their IT needs at minimal cost, and this has given birth to the software as a service industry. Also, many US companies have been outsourcing more, which shifts labor costs out of the US into lower cost countries. And then you have to consider the non business related things that have happened. Low interest rates over the past 2 decades have made financing very cheap, which has supported earnings growth. And there was also the Tax Cuts and Jobs Act in 2017 that lowered the corporate tax rate from 35 to 21%, which instantly makes companies more profitable. Now, another reason that gets pointed out in explaining the strength of the US markets, and something that's been getting talked about a lot more recently, is the growing US national debt. Deficit spending by a government generally helps increase company earnings, especially when it makes up an increasingly larger share of a country's GDP. It's a policy response by a government to support economic growth, which is the case in the US right now. It's at a level now that we've really only seen when the US has either been in a recession or it was during a war. The deficit spending is funded by the US government issuing debt in the form of treasury bonds. So all of this spending is essentially injecting new money into the private sector. sector. When the US increases its spending, whether it's on things like military, infrastructure, social security, that spending will eventually find its way into the hands of individuals, whether it's in their higher incomes or in their stock portfolios through companies generating higher earnings. Now, the US does have the luxury of being the world's reserve currency and will continue to hold that title for the foreseeable future. The global confidence in the dollar effectively allows the US to fund these large deficits without a collapse in borrowing capacity because there's just so much demand for a safe haven asset like a US Treasury bond. Now, since the US stopped quantitative easing in 2022, these deficits have now been financed through borrowing from the private sector and borrowing from other countries. Here's a chart showing which countries in particular are the biggest holders of US debt. And as you can see, Japan is first and China is second. And this has to do with the trade surpluses these companies run with the US. Japan exports a lot of goods like cars and electronics to the US, and China exports a vast range of manufactured goods. So the money that these countries earn from their trade surpluses with the US get reinvested back into US treasuries in order to ensure their currencies remain competitive against the US dollar, which is essential for export-driven economies like China and Japan. And this demand for the US dollar causes the dollar to appreciate in value relative to the Chinese yuan or the Japanese yen. So a weaker currency for them makes their exports more cheaper and thus more competitive in the international markets. So this means that ongoing deficits for the United States make them increasingly reliant on this foreign financing. Because if foreign demand for treasuries declines due to geopolitical tensions, for example, the US may face higher borrowing costs or struggle to fund its deficits in the future, which is why many believe that the current pace of increase in the national debt is not sustainable long term. It's the so called crowding out effect. It's the fact that the government competes with the private sector for investment dollars to fund its deficits. So, if the government is running more deficits and requires more money in order to fund those, then the cost of debt across the whole economy will increase. And as I'm sure we all know, higher interest rates slow down an economy. It discourages businesses from reinvesting, it encourages individuals to save more as opposed to spend more, and it can slow down economic activity and increase unemployment. This is a more long term problem. Now, whether or not deficit spending can boost the stock market in the short term is something that's still up for debate, and deficit spending is just one of many variables that can influence stock market performance. For example, a study done by Charles Schwab found that there is no correlation between deficit spending and US stock performance. But a separate study found that there is a positive correlation between the US debt ceiling and the S&P 500 index, indicating that as the debt ceiling increased, so did the S&P 500, which I don't think would surprise any of us because as the US economy has grown, the stock market has obviously grown along with it. So with that, the debt ceiling has grown as well. And this especially feels true in recent memory since the last time the US ran a budget surplus was the early 2000s, and the US market since then has obviously done extremely well. And even looking back just 10 years ago when the budget deficits really started expanding, US stocks have produced a near 200% return over that time frame. So here's what the US national debt looks like right now. It's increasing and it's increasing at a faster rate. In fact, it took the United States 220 years to rack up its first $11 trillion in national debt, but since the year 2020, it's already added an additional $11 trillion in debt. Now, this chart in particular has been worrying investors. Deficit spending as a percentage of GDP. We can see that the US hit peak debt to GDP during the World War II era and then started increasing around 2008 when the government provided stimulus during the Great Recession. Now, this has been the US's playbook for preventing recessions for a while, more government spending and also sometimes quantitative easing to help boost the economy during a recession. But right now, we're not in a recession. Deficit spending can be a short term stimulus to an economy, but it's not a sustainable driver of economic growth over the long term. And now that Donald Trump has been reelected, a major part of his platform was to reduce corporate taxes, eliminate taxes on overtime income, and in general, deregulate businesses. Really, the only thing he's proposing that won't further increase deficits is the tariffs he wants to implement. It's been estimated that this will make the budget deficit 9% of GDP in the future, which means the US will have to increase their bond issuances to make up for the lost tax dollars, and the interest cost on the debt will also go up with that. Now, technically, there is no limit on how high government debt can go, so long as the US economy continues to grow with it. A debt crisis happens when debt as a percentage of GDP gets out of control control, and buyers of those bonds start to lose confidence and begin selling them. And under Trump's plan, the national debt is projected to grow quite a bit, up to 143% of GDP within 10 years' time. So, at what point does the national debt become a real concern? Well, generally speaking, debt becomes a problem when it can't get paid back. But it is different when it's a government that's issuing the debt and they're issuing the debt in their own domestic currency. We all know that the US is never going to pay off all of its national debt, but what they will have to pay off is the interest on that debt as it becomes due. So, what really matters is one, if the tax revenue that they can collect can keep up with those interest payments, and two, that those interest payments don't consume too much of the federal budget to where funds are being diverted away from productive things like infrastructure or social security and being redirected towards paying the interest. In 2024, interest made up 1.1 trillion of the total budget, which was more than any other item, including Medicare and defense. And interest costs have been rising rapidly in recent years, especially after the rate hikes of 2022. So it's gotten to a point where it now makes up about 21% of tax revenues received, which is up significantly compared to just 2 years ago when it was 13%. Now, according to the IMF, a debt service to tax revenue ratio under 250% is what's considered sustainable. Or, in other words, debt service shouldn't make up more than 20% of tax revenues. Once countries start to pass this level, historically it's been problematic. So the US does currently exceed that, and with deficits set to outgrow the economy in the next few years, and interest rates still being somewhat high, this will likely continue. But that guidance from the IMF is for all countries, and the US is a very unique country in that they run massive trade deficits with other large countries, but their currency is seen as the global reserve. About 60% of global reserves are held specifically in US dollars. And even though some foreign governments have been reducing their holdings of US treasuries, foreign private entities have significantly increased theirs, which has more than made up for the gap in recent years. And as we can see, the US was in this same scenario before, back in the 1980s. But eventually, as interest rates were reduced and the economy continued to grow, which supported growth in tax revenue with it, the ratio did decrease. But one thing for sure is that the deficit spending that's been going on that exceeds the rate of economic growth in the US is something that is not sustainable. And if it continues, then eventually there's going to need to be a push to rein it back in. So let me know what you think of this in the comments, guys. Do you see the national debt as a problem or not? But I hope you did enjoy this video and you found it insightful. If you did, then please leave a like. And if you're new to my channel, I'd appreciate it if you would consider subscribing. And I'll see you guys in the next video.